Hey guys, I wanted to wish you all a happy new year, and I was going to be posting my market review going into this next year. So if you go back to corrections, it always happens in 7-year cycles. So if you go back to 1995, it was the Cold War, and then oil prices were really high, real estate was down. I remember this because my dad, his best friend had made a SPAC. Their stock went from like $1 to $100. So their $10 million became $1 billion. And they bought all this real estate in LA. From 1995 to 2002, that's a 7-year time period, right? In the dot-com crash leading into 2002 bottom, at the height of that was a 44 PE level for the SPY, and it was at 25% tech at that time. Then after 2002, it climbed up for another 7-year period. 2008 and 9, financial trouble, the market crashed. It dropped down for 2 years. I was actually part-time in mortgage and real estate. I kind of saw all that was going on. 7 years later, from 2009 to 2015-16, was the China trade wars. Now, in 15-16, that's when I was heavy into fashion and doing a lot of consulting for a lot of businesses, mainly import-export companies from China. So I saw what happened with the China trade wars. And I was also trading at that time. I started trading from 2012. So from 2012, the market went up nonstop all the way into 2015. He tried to bring manufacturing back to the US. So during that time, the market was really choppy. Apple was trading really low. Microsoft, a lot of the tech companies, they were trading at PE levels down to like 9, 10, which was its lowest. Now, during that time, Carl Icahn had actually said to Tim Cook several times in 2013, buy back shares. So with all the free cash flow that Apple had, they started buying back shares. What it does is reduce the share amount so that every time that they report earnings, it makes their earnings per share higher. Because when you get revenue divided into shares, you get the EPS, right? Well, what if you get the earnings or the revenue and divide it by less shares? That means your EPS is going to be higher. So it started raising the price of Apple because the earnings per share was higher. So going into 2018, Feds had to increase rate hikes again, right? So starting in January, they started announcing, okay, we're going to be increasing rates throughout the year. Finally, by December, Powell came on December 19th, and he said, okay, we're going to start decelerating the rate increases. They're still going to have rate increases, but at a decelerated rate. So it's almost similar to what we're going through now, even though it's worse economic conditions. But that's why our P levels are trading a lot lower than previously in 2018. Every time that they did a rate increase, the market pulled back going into the next year in 2019 in February, and 2 more times as the rate hikes trickled in. But because these companies are still producing earnings, it compensates for the rate increases because they're making more money faster than the rate hikes are depreciating their future assets. It allows the SPY to go up, which is all based on valuation. So if you go jump over all the way into 2019, the market starts ripping starting from Q2, which is usually after July. So July into 2019, market starts ripping. And then what happens is COVID, right? 2020. And in 1 quarter, it fell, but within 1 quarter, it bounced right back on track to where it's supposed to go on its normal growth rate. The problem here is that during COVID in 2020, everybody got stimulus, right? So there's now new money in the market. So that new money is now trading because they're so hyped about like companies like GME. But at the height of 2021, the PE levels now on average was 38, which is a lot less than in 2002 or 2000. With 2000, it was at 25% tech with a 44 PE. In 2021, it was 32% tech with a 38 PE on the SPY. Now, why does this make a big impact on the market now? Is people are trying to say, okay, the market is supposed to trade at much lower PE. But if you look at when Google was added to the S&P, because Google wasn't even a part of the S&P, Tesla wasn't even a part of the S&P at that time. If you see Apple, right? So if you want to learn how the market trades on an average quarterly basis, you can base it all on Apple. Apple trades 15 points per earnings quarter. Every 25 basis points hike is a 3-point depreciation in Apple valuation. $3 times 16 billion shares is about 48 billion, right? If they make that per earnings, then what happens to Apple? It just goes back to where it's supposed to be. Their earnings covered a 25 basis point hike. Anything above 25 basis points will make it fall another 3 points every single time they raise rates. But if they say they're not going to raise rates, Apple has a chance to now go up because every time they earn earnings, that's going to cover the rate hikes. Apple trades in a 15-point range. Last quarter, it was 134 to 149. The options chain is showing that it's going to have also the same expected move from 50 delta, where it should be at the money, into the earnings date. So earnings is on January 25th at 11:50 or so. Expected move. I charted my Apple chart exactly how earnings moves. So I use Fibonacci trading to determine ranges, as long as you know how to draw it. But I teach that in my class as well. But these are my ranges going into Apple earnings for quarter 4. I think for Tesla, valuation of Tesla, they're trading at like a 38 PE now. If you look at the height of 2020, they were trading at 1,000 PE. So that 1,000 PE is much higher than current, right? If you look at the revenue growth, they're growing at a 58% revenue growth despite the delivery numbers. And they're increasing also in EPS year over year by 5 times. And I think SPY would go to 407 into February. And you could see that in the expected move for February. So February 17th is showing 407 or 360 low. So let's say that FOMC minutes and CPI data comes out. If they're saying, okay, we're planning to maybe only raise 25 and consider even reducing it next meeting, then you can start heading into higher and higher ranges, right? Going into February, March. Based on positive or negative data coming out and Fed's sentiment, whether he's hawkish or dovish, then I would aim for the 360 to the downside. Know your ranges, use the expected move. If you don't know what the expected move is, make sure to watch my previous video on expected move, because that's going to really help you, as well as the implied volatility, how to get the price targets. So good luck trading and Happy New Year again. I hope everybody is blessed tremendously and we all make a lot of money together. Bye.